Corporate insolvencies are rising across Asia Pacific despite global resilience. Cases are up 12%, and Asian bonds saw 5.48 billion US dollars in September outflows, the largest in over 3 years. Joining us to unpack the risks are Bernard Off from Cofis and Vikash Halan from Moody's. Bernard and Vikash, what's behind the recent rise in corporate insolvencies across Asia Pacific?
Across Asia Pacific, as you alluded to, corporate insolvency are spiking. Several markets are seeing double-digit increases, like Singapore, Australia, Hong Kong, South Korea, to name a few. So this isn't random; it's a pattern, and really the patterns tell a story. There are four forces driving the increase. The first one is that interest rates stayed high, so cheap money from the pandemic period is gone. Debt-laden, debt-heavy businesses are now facing brutal refinancing costs. And then second one is the pandemic backlog now hits. Governments has delayed the pain with support packages and prudential measures in the early COVID years. All these are gone now. So companies with weak balance sheets, they are in trouble. The third reason is that demand has weakened globally. So as global trade slows, export-driven economies, they are hurting. Less demand means also more financial stress. And the last one is really sectorial fragility. And what do I mean by that? When you look at construction, wholesale, trade, services, they are cracking big first because they have thin margins, and coupled that with higher costs and delayed payments equals financial pressures. But what we are seeing now over the past few months is there is a sense and early signs of calm in the market. So, but don't get me wrong, insolvency aren't disappearing, but the pace is slowing.
Really shock after shock that we have seen that the corporates have endured, right, starting from COVID, and then the Russia-Ukraine war, and most recently we've seen the trade disruption with US tariffs. Combining with that is higher interest rates, and we've had some COVID era government stimulus that has been taken off. So when you combine all of that, it's no surprise really that we are seeing slower growth in most of the economies, and therefore we are seeing some of the corporates defaulting.
Vikash, how are interest rates and credit conditions affecting corporate solvency?
As interest rates go up, the corporates tend to have lower interest coverage ratio, which tends to affect their bank covenants, and they hit their covenants, they need waivers, and if they are unable to get waivers, they will have to repay the loan. And if they are unable to repay, of course, that's the default. In addition, the higher interest rates also affect their ability to borrow more, and their access to funding does get curtailed. So some of the corporates who are in the middle of their expansion, they could also face challenges in completing their projects. And again, that results in them having higher leverage and therefore default. The higher interest rates also affect their business because some of their customers are unable to afford some of their products. So they may end up not buying, and therefore the revenue for the corporates to come down, the profitability gets a hit.
So if you think of money as the oxygen that businesses breathe, and interest rates are really the controls over that oxygen flow. So when interest rates rise, the air gets thinned. When they fall, the companies can breathe a little bit easier. So interest rates are simply the cost of borrowing, and higher interest rates means more expensive loans. Businesses then have to pay more to refinancing their debt to fund their operations or to even invest in expansion and growth. Credit conditions describe the company's access to capital. So you can imagine tight credit equals fewer lifelines. Banks become cautious, they raise collateral demands, they shorten credit terms. On the other hand, loose credit means more liquidity and easier refinancing.
Now, what warning signs should lenders and investors watch for?
The first one is, of course, cash flows. If you see bills piling up or payments slowing down, if you see stretching accounts payables and delay receivables, that's a classic liquidity stress. Number two will be your debt levels. So a companies that relies heavily on borrowing to fund their operations, and they are frequently having to refinance at higher interest rates. or their interest coverage ratio is rising, especially if their earnings cannot cover the interest payment that they have to pay. This is a red flag as well. The third one will be really the profit margins or any consistent losses. So if you are a company that have healthy margins, they can absorb shocks like rising costs, slowing demand, greater competition, and so on. So if margins for these companies, they are eroding or there are consistent losses, they are flashing red lights. There are others as well, like operational red flags are one of them. If a company is cutting staff, employees aggressively, or they are suspending projects that they should be doing, or selling some of their core assets, these moves really scream to us that they are in survival mode, not a strategy. Or if there are changes in credit behavior, the companies requesting for more extended terms or factoring invoices or even emergency credit lines.
I would say effectively three warning signs that you can focus on. One is financial, so higher leverage, lower interest cover, weak liquidity is definitely a sign of stress or potential stress. The second set of uh, indicators are behavioral, where if the corporates themselves are borrowing on a short-term basis and increasingly very short-term basis, that's again a sign that the corporate is finding hard to get long-term financing. And also, if they are curtailing some of their capex plans or they are deferring some of their shareholder payments, it's again a sign that they are in a difficult situation. The third set is looking at some of the macro drivers. If we are revising growth for some of the economies, or if there are higher unemployment numbers coming. So, if you're looking at some of those macro signals, that can also show which portion of your portfolio, which geography is going to be more exposed.
Thank you so much for your time today, Vikash and Bernard.
Thanks for having me.
Again, those are Bernard O, Chief Economist for Asia Pacific at COFACE, and Vikash Halan, Managing Director at Moody's. For more news, please visit asianbankingandfinance.net.